The first country presentation will be delivered by Professor Andreas Bergmann of Zurich University of Applied Sciences. The title is Accounting for Pensions in the Public Sector in Switzerland. Professor Andreas Bergmann is Deputy Dean of School of Management and Law at Zurich University of Applied Sciences of Switzerland. His main research area is public financial management. He served as chair of IPSASB and currently is a member of OECD Advisory Panel and IMF Advisory Committee. Professor Bergmann, you can start your presentation. You are given 15 minutes.
Thank you very much for inviting me to present the Swiss case here, and we have already heard that this case is in some ways similar to the Korean case, but in some ways also different from the Korean case. So I hope you take away some of our insights. I will share a presentation with you, and let me just bear a few minutes now. Yeah, I hope you can see the presentation right now, and so it should be up now. Yeah, perfect. So the Swiss case is, of course, based on the Swiss public pension system. So that's why I will first talk about the pension system as such, so you get a better understanding how the Swiss pension system works. Secondly, I look at the accounting standards which are applied in Switzerland. And thirdly, we combine the two things. We look at the accounting treatment of pensions in the public sector of Switzerland. The Swiss pension system is a three-pillar system. We have three pillars, which you can see here vertically. That's pillar one, which is a basic pension. It's a general scheme for the entire population. So you can see it really doesn't matter whether you are employed in the general government sector, in the wider public sector, in the private sector, or even if you're not employed at all, you will still be part of that pillar one, the basic pension insurance. We have a pillar two, and the pillar two is the occupational benefits plan. So this depends on your work. If you're employed in the general government sector, or in the public sector, or in the private sector, it depends on the plan, because all entities have a different plan. However, the legal basis is the same. So you can see it's the same law, which is here quoted, which is applying to all entities. However, the scheme itself is different. For instance, for the federal pension, for the federal employee pensions, it's Publica. For the public sector, there might be public or private sector providers, and for the private sector, there are private sector providers. So actually the schemes do differ, but they are under the same umbrella of Pillar 2. And then Pillar 3, this is sort of the individual voluntary pensions, which you can do. There are some tax incentives to do so, but it's all private and it's not related to your employment. So we will not talk about this third pillar at all, because it's really individual. We will talk actually about this orange boundary. We will talk about Pillar 1, which is the general pension for the entire population. And we will talk about the Pillar 2 as far as government employees and employees of the public sector are concerned. We will not talk about private enterprises. Now, what standards are applied? Switzerland, since 2007, is applying IPSAS's International Public Sector Accounting Standards for the federal government and for the larger states. For the smaller states and for the municipalities, we apply what is called the Harmonized Accounting Model 2, which is a simplified version of IPSAS. It generally follows the principles of IPSAS, but might include some simplified accounting treatment for those smaller entities. Then we do have a national standard for the private sector, actually, for the smaller entities, for the smaller corporates, which is symbolized by this small industrial symbol, and also for the pension plans itself. So this standard is providing a standard for pension plan accounting. So not only for the employer, but for the pension plan itself. And finally, the larger corporates in Switzerland apply IFRS, the International Financial Reporting Standards, which of course also have a standard about employee benefits. So bottom line, we have 4 kind of standards which are being applied. IPSAS is for the larger government entities, such as the federal government and the large states, with IPSAS 42 on social benefits starting from 2021, so from next year, and IPSAS 39, which is already applied. And you can see that actually this is related to the pillars. So in Switzerland, we have a relatively clear-cut situation that we can apply IPSAS 42 social benefits to Pillar 1. Why? Well, because it is a general public scheme. It's not employment related. It applies to the entire population. So it is a social benefit as defined in IPSAS 42. The Pillar 2 is an employment-related scheme. So it is actually a scheme which relates directly to what is called an employee benefit in IPSAS 39. And therefore, we have sort of the same distinction that the IPSAS B has made, distinguishing between IPSAS 39 and 42 for our pillars 1, 42, and 249. For the harmonized accounting model, we have a recommendation, it's recommendation 9, which is actually based on IPSAS 39. We do not have an equivalent for IPSAS 32, or at least not yet. This might be something which could be developed in the future, but so far those smaller entities have not seen the necessity because most or virtually all of the social benefits are actually provided by the national government, and therefore IPSAS 42 will be applied from next year on. And then we have, of course, also pension obligations of corporates, which are employee benefits for Pillar 2 in Swiss GAAP, FER, and we also have the accounting of the pension plan in Swiss GAAP, FER, norm 26. And as I mentioned, IS 19 for the corporates. So what is now the accounting really? Starting off with Pillar 1. So I'm here in the basic public pension. Right now, or until 2020, this is the last year actually where the accounting for this pension is cash accounting. So until now we have used cash accounting, but now having IPSAS 42 available, starting in 2021, we will move to accrual for this general public pension as well. And the criteria will therefore no longer be the cash payout, but when all eligibility criteria are fulfilled, we will recognize a liability, and we also recognize financial assets based on the financial instrument standard, which is called IPSAS 41. So basically we move to full IPSAS accrual accounting from 2021 for that basic general public pension. Just to explain, Comp & Swiss, this is the agency which is providing these pensions to the general population. For the Pillar 2, it's slightly less harmonized because obviously we have different entities and different plans which are providing these employment pensions, occupational pensions. For the national government, we have one plan, which is Publica, as you have seen before, and the national government is using IPSAS 39 for the accounting of that liability. It is actually a hybrid plan, like all plans in Switzerland. It's the shared risk between the employee and the employer, and IPSA 39 permits to share that risk. For the subnational governments, we do have some large subnational governments like the states of Zurich, of Geneva, of Basel, which are also applying IPSA, so their accounting for their pension plans is exactly the same as the one for the federal government. And then we have some states which are using actually the private sector standard for their liability, which is very similar, or the small states and also the local governments are using recommendation 9, which is a simplified version of IPSA 39. So generally speaking, they also recognize a liability. However, the calculation of that liability might be simplified, and in particular, the note disclosures are much simplified in the local governments. And finally, public sector financial and public sector non-financial corporations, so the state-owned enterprises, they either apply IAS 19 if they are really large, like the Post or like Swisscom, or they apply Swiss GAAP FER 16 if they are smaller and are in the medium-sized enterprise sector. So basically what I can tell you is what we have already heard in the first presentation: all entities in Switzerland recognize a liability for those employment-related benefit plans. However, they use slightly different standards. Some are using IPSA 39, some are using the harmonized accounting model, recommendation 9, and some are using private sector standards. When it comes to the pension plans, and I think this is also interesting, the pension plans in Switzerland, they all use Swiss GAAP FER 26, which is also showing liabilities. Obviously, it's an accrual basis standard, which is tailor-made for the Swiss pension plans. That's why they are using IPSA, not IPSA of course, but Swiss GAAP FER 26. In conclusion, we have a very clear separation in Switzerland between the basic pension, which is a social benefit, and the occupational benefit plans, which are employee benefits. So we have a very clear separation between Pillar 1, which is social benefits, and Pillar 2, which are employee benefits. This really helps in accounting because actually the standards also follow this same separation. So we have for social benefits until today cash accounting, but from 2021 onwards we will use the new IPSA 42. And for employee benefits we have IPSA 39, HAM 2 number 9, or Swiss GAAP FER 16 or IAS 19, which all require a liability to be recognized, which might be slightly different in the calculation, but bottom line, the treatment is very much the same used by all four standards. And finally, yes, we do have a national standard for the pension plan accounting, so how the pension plans themselves account is based on Swiss GAAP FER 26. Thank you very much for attending this presentation, and I'm looking forward also to be part of the panel towards the end of this seminar. Thank you very much.
Thank you so much, Professor Andreas. As far as I know, it is 6 a.m. in Switzerland. Thank you so much for joining us in this early hour. Second case study is accounting for pensions in the public sector in France. Senior Manager Fabien Colignon of CNoCP is going to deliver her presentation on the French pension scheme in the public sector and current issues. With her experience in accounting firm and French Financial Market Authority, she's currently serving as a senior manager in CNoCP, Public Sector Accounting Standards Council, and a member of CAC Advisory Group of IPSA-SPI. Please welcome Senior Manager Fabien Colignon. You are given 15 minutes.
Can you hear me? You should be able to hear me. Okay. Sorry. Thank you. Thank you very much for giving me the opportunity to explain the pensions system in France from an accounting perspective. I will walk you through the legal background. If you go to the next slide, please. I will walk you, thank you, walk you through the legal background first and the accounting literature on pensions in France and some key issues we face. Going to the next slide. To be fully immersed into the topic, I set up the diagram here as a good introduction. I apologize as it is in French. Anyway, roughly, what you should remember from this diagram is that there are 42 different pensions regimes in France, and that is therefore a very complex area from a political perspective. However, from an accounting viewpoint, the regimes are all based on one same mechanism, which is what we call the répartition mechanism. And we'll see the features of such mechanism a bit later. Also, and this is an important element of context, two different finance laws apply, one for the central government that deals with state civil servants, and the other finance law applies to the social security sector, and it deals with employees from the private sector. Some words now on the legal background of the French pension system. So please turn to the next. Thank you very much. What we have in our constitution with respect to pensions actually drives the way they are managed, the regimes are managed. Indeed, while the constitution states the overall principle of national solidarity, it does not set the way national solidarity should be operationalized. And this bears consequences as to the way regimes are managed, hence how they're accounted for in the financial statements. Then we have a social security code that builds on the national solidarity principle. The code sets the idea of compulsory contribution to regimes. The whole system is referred to, as I said, as the répartition system, and the 42 regimes fall under this label. Next slide, please. So, what are the consequences in terms of operations and the way the regimes are operationalized? In the social security sector, that mainly deals with employees from the private sector, contributions are compulsory and the relationship is between the employee and the social security sector, not with the employer. Those pensions regimes are therefore not within the scope of IPSA 39, employee benefits, rather they are accounted for under similar principles as in IPSA 42, social benefits. Now, as far as the central government civil servants are concerned, the regime is considered to operate in the same way as the regimes managed by the social security sector, especially in that the entity that is responsible for paying pensions operates under, again, the repartition mechanism. This means that the entity performs year on year within the confines of annual finance laws that ensure that the system is balanced through budget authorization and determination of contributions for the period. However, where the central government does not recognize future pensions as a long-term liability, the notes, the financial statements, do provide extensive details and measurements in accordance with the measurements required in IFRS 39. It is also to be noted that the System of National Accounts 2008 provides for this situation. Indeed, if pensions for civil servants are managed in a way similar to that of the social security sector, then this may allow for the absence of recognition in national accounts. So there is consistency there. And again, the key point here is really the political organization and how the reporting entity is determined. I'm conscious of the time, so I suggest we skip the next slide, which is really on the social security sector, which is not really the focus here. So if you could, next slide. Thank you. So just let's take a quick glance at the recent accounting literature in France. First of all, the conceptual framework for public accounts in France states that public sector reporting entities operate under public policies and report on rights and obligations that they can be held accountable for. And because the sovereign power of the nation is not a reporting entity that establishes financial statements, overarching principles from the Constitution are not subject to financial reporting per se. The conceptual framework also mentions the importance of the budget as the enforcement mechanism to operate public policies, a consequence being that mere expectations cannot be accounted for, hence constructive obligations to carry out public action do not give rise to liabilities unless expenditures were voted in the reporting period. However, this does not mean that forward-looking information should not feature somewhere, and this is where the debate stands in France at the moment, at least for the social security sector. Obviously, the central government, it's in the notes to the financial statement. In that sense, Opinion 2016-1, published in January 2016, more specifically addresses the issue from the social security sector standpoint, but at this stage only encourages discussions to progress further so far as to reach consensus on the level of aggregation of accounts at which relevant forward-looking information could be provided. And that topic is still in progress in France, and it's a huge issue. And it's really to do with, again, the organization and the way the entities are set up and the way they operationalize the regimes. Next slide, please. So the key issues that are still under discussion in France, it's the definition of the reporting entity. The reporting entity, as I said, the aggregation level at which the reporting entity that will define the aggregation level at which information could be provided. Again, this is all about providing information and not recognizing liability in the balance sheet. And there is also, as I said, the importance of the vote of the budget. So the present obligation to ensure that the scheme will last over time, if any, may exist at the level of a nation that is not in itself a reporting entity. So because we can't have that at the nation level, we will have to see at which level and how we can engage as entities to provide a good level of information. And the individual entities themselves only operate the pension policy and cannot be held accountable for the future obligations of such pensions. So that's where we have the tension. The next point is to enhance consistency between the presentation in the central government and in social security entities, because again, in the central government, we have those notes in the financial statements, but we don't have forward-looking information in social security entities. So we need to determine the nature of such information to reflect the forward-looking financial equilibrium of pension schemes based on the financial forecast of payments for future pension benefits and of resources allocated to their financing. And again, one limit is that the way the social security sector is organized, with no predefined controlling entity. So again, the way it is organized. Now, quickly, we are planning a future reform. Well, we were before the crisis, the COVID crisis. Still, the fact that there are 42 pension regimes makes it quite difficult, and there's a strong perception that the system is unfair. So there is an ongoing reform that we might shift from the current system to a system in points, and then that would mean that the same rules apply to all, which should help with the perception that the system might be more fair, and that would cover employees of the private and the public sectors. And this is a reform which is not entirely new, which will not bring a completely new perspective, because the point system already exists in France in some supplementary schemes that have been operated for more than 50 years. So again, it's not entirely new, but we still have to figure out how what will be the consequences in terms of accounting. I skipped the next slide, which it dates back 11th of June, so it might be even, it's supposed to show the impact of the COVID crisis, but dating back in June and going, given the context we're in at the moment, it will probably be even worse than that. So thank you very much for your attention. And I would be more than happy to answer any question you may have to the best of my ability. Thank you very much.
I understand France is very early now. I think it is around 7 a.m. in France. Thank you very much for joining us in the early morning. We will have a 5-minute break. The third country to present is Japan. The presentation will be delivered by Professor Ryota Kaneko of Kokugakuin University of Japan. Professor Ryota Kaneko is an expert in Japan's public sector accounting. He teaches accounting at Kokugakuin University in Japan, and he is a CPA for USA and Japan. He currently serves as member of JICPA Government Accounting Research Committee and Chief Examiner of Not-for-Profit Accounting Committee of Cabinet Office. Professor Kaneko, please go ahead.
Okay, thank you very much, and hello everyone. Yeah, 안녕하세요. I'm Ryota Kaneko from Tokyo, Japan, and I'm very happy to have the opportunity to make a presentation here. Yeah, and today I would like to talk about accounting for public pensions. Okay. With this, please. Okay. So today's topic, first, how is the pension system in Japan? What are the concerns? The second, how accrual accounting is introduced and how is it? The third, what are the challenges of pension accounting in Japan? Okay. So first, how is the pension system in Japan? We have two major characteristics in our Japanese pension system. One is two-tier system, the other is assessment plan. In two-tier system, we have basic pension, and in addition to basic pension, we have employees' pension. And national pension covers all citizens, and welfare pension covers all employees, including government officer. So we used to have government officers' pension plan, but these pension plans are unified into one system in 2015. And we do adopt the assessment plan, which is also called a pay-as-you-go plan, which means active generation support pensioners with current social insurance payments. But we have pension reserves. In theory, the level of pension depends on the pension premiums paid. But we intentionally have some pension reserves for the future, for the aging society. So now we have the pension fund reserves more than 100 trillion Japanese yen, more than the 1 trillion US dollars. So we need to maintain these fund reserves as long as possible, but we may need to use these fund reserves for the future. So it's really important how to account these pension fund reserves to the public. Okay. So what are the concerns about our pension system? Yeah, like many other OECD countries, now we are facing the declining birth rate, aging population, and average life expectancy. So yeah, these factors lead insufficient pension benefits, so we do need the pension reform. Okay. So, but we still have some positive factors for the pension. Now, we are especially, at least before COVID-19, we are full employment and almost very low unemployment rate. And more women are working in the company, so there are more workforce. And so far in these 15 years, we have had better investment income than we expected in 2000. And now many people do extend their retirement age until 70 or even 75. Actually, my father is 75 years old, but he still works as a full-time worker. But even there are some positive factors, we do have to have pension reform for the future. So we do have to increase the pension premium, and we do have to decrease the pension benefit. So we have had some pension reform, but the biggest one is in 2004. It implemented the macroeconomic slide, which means that pension level adjustment for current and future pensioners. So our pension level may go down year by year. But to do the pension reform successfully, we do need the disclosure and we do make the pension system transparent, to be transparent. So we do need the accrual accounting. And this is the overview of our Japanese government financial statements. And pension special funds reporting entity is the pension special account. So pension special account has its own financial statements, and pension special account is regulated by the Ministry of Health. So Ministry pension special accounts financial statements are combined into the Ministry's financial statements. And we have 12 ministries and 17 special accounts, and pension special fund is one of them. So after each ministry prepares the financial statement, they are combined into one whole of government financial statements. And pension special account is one of them. So, next slide, I will show you the financial statement. We have balance sheet, operating expense statement, statement of changes in net assets, cash flow statement, and schedules. As you may notice that the name is different from that of IPSAS, so we have our own accounting standards. So now I would like to talk about our law. According to the finance law here in Japan, the budget is still based on cash. So it means that we have both cash and accrual-based information. And budget is made based on cash, so and accrual information is not prepared not by the double entry bookkeeping system, but by adjusting this cash-based information. So here in Japan, at first, the cash-based information are prepared. And then there is some adjustment to this cash-based information, and then accrual-based information are prepared. And then these information are audited by Board of Audit of Japan, and then these informations are open to the public. So now I will show you how our pension liabilities are recorded. This is the balance sheet of our special pension account. As you can see, the asset side, cash and pension trust fund are the majority of the assets. These are the reserves. And in the liability side, you can see public pension liability. It's almost 120 trillion Japanese yen. It means that these cash and pension reserves are considered to be the liability. Because these cash and pension trust funds are restricted for pension payments only. And government cannot use this cash to the other purposes, and it's by law. So we consider these, at least we have to pay these reserves as a pension payment in the future. So we consider it as an present obligation. So we can categorize the published pension liability as here in liability. And there are some minor accrual items, but it's really small number compared to the cash, pension trust fund, and public pension liability. And in the operating expense statement, usually the expense is the pension payment after adjusting some accrual items. And pension assets and liabilities account for about 10% of our assets and liabilities in the whole country. And probably, according to the IPSAS 42 social benefits, this public pension liability may not be considered as liability. So, but even in the balance sheets, some are recorded as liability, but it's not future payment of our pension payment, and future pension premium is not recorded on the asset side. So we do have a lot of additional information in the notes. And most important part is physical assessment in 2019. it shows a future pension payment, and future pension premium according to some scenarios. Depends on the price level or economic growth rate or some other factors such as the life expectancy and so on. And we do physical assessment every 5 years, and usually the policy for the pension is decided by this physical assessment. But these information are not made by the accountants, but made by the economists. Okay. So, I'd like to summarize our accrual accounting, and I'd like to show you about the future challenges. So, accrual accounting in Japan, in the pension part, in the pension special account, we have assets, mainly the pension fund, and we have liability. It's almost the same as the reserves. The future payment is not fully reflected in balance sheet, but shown in the notes. And in the policy making area, these policy making are mainly based on physical assessment and not by accounting information. So the future challenges are maybe the accounting profession can have more important role for the effective pension reform. And second, nearly 20 years have passed since we established the accounting standards for the government. So now I think it's time to revise or reconsider the overall framework and accounting standards for the government in Japan. So adoption of IPSAS is the reasonable option. And in the policy making area, usually the economists are more interested in these pension issues, and accountants play a very limited role in this area. So now it's really important to have cooperation between economists and accountants. So that's all, and thank you very much for listening. 감사합니다.
Thank you very much, Professor Ryota Kaneko. It will be followed by the presentation from Professor Hwan of Graduate School of Public Administration at Seoul National University. He will discuss the current status and future tasks of public officials' pension in Korea. Professor Kim is committed to improvement of Korea's public sector accounting through his research. He serves as member of the Government Accounting Review Committee at the Ministry of Economy and Finance, and also member of Government Accounting Advisory Board at GAFSC. Professor Kim, please go ahead.
From Seoul National University, and I'm pleased to be in this symposium, which is very, I think, interesting and important topic about the public accounting, public pension accounting. So today I will discuss about public officials' pension in Korea. So the topic I will discuss is, first I will discuss about the pension system in Korea, and then I will overview public pension in Korea, and then we'll discuss about recognition and measurement of pension and current status and trend, and then I will discuss issues related to the public pension in Korea, and then I will talk about future tasks. Let me explain pension system in Korea. So as you can see in the box, we have 4 layers of pension system in Korea. The layer 0 is for the low income person, people. So this is for the bottom 20% of income level people. So for the general public, we have 3 layers: layer 1, 2, and 3. And for the public officials pension, which is here in the box, specialized occupational pension, actually mix of layer 1 and 2. So for the general public, they are people join national pension, as a layer 1, and then they have a retirement pension from their employer. But in Korea, public officials are prohibited to join national pension. So public pension actually include both national pension and the retirement pension in characteristics, and this will make all confusion in how to recognize public pension liability in Korea. Current public pension in Korea has started in 1960, and since then it has over 2 million public officials joined in this public pension. And government subsidize this public pension over 2 trillion Korean won every year, because the expense exceed the revenue. So this government subsidy is on the top of 9% of remuneration budget as an employer of the government. So the public officials contribute 9% of monthly standard income, plus government add another 9% of remuneration as an employer, and on the top of that, government subsidize 2 trillion Korean won every year. And the government tried to improve the sustainability of the public pension because of this, continuous subsidy and expected, growing subsidy in the future. So they have several reforms by increasing contribution rate, at the same time decreasing payment rate. And in 2015, it was very significant one, and government decreased the payment rate from 1.9% to 1.7%, and increased contribution rate from 7% to 9%. And this 2015 reform enhanced fiscal sustainability and equity with the national pension, which is for general public. Now I'll talk about how to recognize this pension liability and how to measure pension liability in Korea. Currently, Korean government treats this public pension as an exchange transaction as an employer. Therefore, government recognize this public pension similar to corporate accounting standards for retirement pension. So we recognize this provision for payment obligation similar to corporate. On the other hand, for national pension, the provision is not recognized because it is considered as a social insurance, and we just recognize unpaid amount of pension benefit as of the date of the statement. So we have two separate recognition method for this, pension. And public pension started to recognize this pension obligation using vested benefit obligation, and then changed to accumulate benefit obligation. Now it is based on the projected benefit obligation. Now let me talk about the trend of public pension liability in Korea. In 2019, the amount of provision pension was 944 trillion Korean won, and this is equivalent to the half of total liability of Korean government in the financial statement. And for this year, which is 2020, the provision for pension is estimated to be over 1 quadrillion Korean won, which is a very significant amount, and important portion of Korean government liability. And this provision, our pension liability, has increased from 596 trillion Korean won in 2013 to 944 trillion Korean won in 2019, which is an annual average increase of 8%. And this is mainly due to the underlying assumption and the recognition method change. So the increase is based on this assumption change. I mean, there was some change based on the service year change, but majority is coming from this assumption change, which increase huge volatility of the pension obligation, which create another issue in Korean pension recognition program. And in 2019, the increase of provision was small compared to prior years, thanks to this favorable assumption change. As you can see from the box, the inflation rate change and the salary increase rate change, forecast change, created 90 trillion Korean won reduction in public pension obligation. So this year was lucky to government in terms of recording this public pension liability. Now let me talk about what kind of issue we have for the provision for pension in Korea. Pension provision or pension liability serves as an important indicator for evaluating fiscal soundness of the Korean government because it's a so significant amount. But as you can see, the volatility of pension liability creates some over or under evaluation fiscal soundness. You can see from the two boxes, only 0.5% decrease in discount rate creates over 100 trillion Korean won increase in pension obligation. And that amount is 5%, close to 5% of total liability in Korean government. So this actuarial assumption change creates volatility of the pension liability in Korea. A second one is, as I explained earlier, the Korean public pension program has both characteristics of exchange and non-exchange transaction because public officials are prohibited from joining the national pension for the general public. However, the current recognition method of Korea does not reflect these dual characteristics of public pension in Korea. So in 2015, reform, the government enhanced this income redistribution to the public officials, strengthening the characteristics of public pension as a social insurance. So therefore, we need to reflect both characteristics in recognition, but we are only rely on the exchange transaction pension program. And the last issue that I want to raise is inconsistency in recognized pension provision. The current practice of Korean government recognize provision for the entire public officials, which is central government, officials and local government officials. And this causes mismatch between the scope of financial statement of central government, because no other asset or liability of local government are recognized in the central government financial statement. Only this pension liability is recognized in financial statement. So I don't think it is consistent in terms of recognizing liabilities and assets of local government. Now, finally, I want to talk about some future tasks or challenges for the Korean pension recognition method. First, I think we need to review the appropriateness of pension provision as a useful information for fiscal burden or fiscal soundness. As I discussed, Korean pension has, explains huge portion of Korean government liability. At the same time, it is very, very sensitive to actuarial, assumptions. So we need to improve the usefulness of information for pension, public pension, to help public better understand the soundness of the government. Second, we need to find ways to distinguish exchange and non-exchange transaction of public pension. Currently, the Korean pension recognition is depend on the exchange transaction, but as we discussed, we have both characteristics. So recently, IPSAS 42 enacted, and that can be applied to the non-exchange transaction. And for the exchange transaction, maybe we can stick to the current, provision, provision or current recognition method. And if we decide to separate this exchange and non-exchange transaction, we need to sufficient study or preparation to standard or estimation method how to distinguish this exchange and non-exchange transaction. And the final challenge is to make the scope of financial statement and coverage identical or consistent. As discussed, local public officials need to be excluded, or we need to expand our scope of financial statement. That's all I have, and I'm looking forward to further discussion on this topic. Thank you.